This screencast is looking at Summer 16 question 2, focusing on foreign exchange consolidations. So one of the most important things about any consolidation type question is, do you have a formal structure in place in terms of steps by step of how you approach a question. And of course this will be different depending on whether it's a foreign exchange subsidiary, whether it's a statement of cash flows you're asked to prepare, or whether it's a disposal. I'll just show you here in terms of my suggested steps. Again, you may have different ones, but the point is to have a tried and tested method in terms of how you go about preparing consolidation with foreign exchange questions. So some of them will be very similar regardless of what question you do, particularly step 1, step 2. Read the requirements to inform you what's been asked, and then look at all the notes and information of the question, and really just strategically highlighting how many companies there are, what are the key dates, is there any mid-years, what's the group structure, and what are the key adjustments to be made. So again, this will be you more practice of reading down through the case or the question given and identifying what's the structure and what are the key points of information that you need to note, including dates, adjustments, etc. One of the first things you'll do then in terms of foreign exchange will be you need to translate the foreign operation, so the foreign subsidiary, the statement of financial position, using IAS 21 rules. And we'll show you how to do that, and we'll show you how to deal with the retained earnings figure, which itself will include some foreign exchange gains or losses. Once you have that done, then you need to calculate the foreign exchange differences as per IAS 21. So remember, you should go back and revise IAS 21. There will be 3 sources of foreign exchange differences: due to net assets, due to income and expenses, and also the retranslation of goodwill. This part here will focus on 1 and 2, the source of net assets and income and expenditure. So we will calculate then what the FX differences for 1 or 2 are. And again, it's very important there you have to identify when was the subsidiary purchased. If you purchased a subsidiary in a prior year, you will have prior year and current year foreign exchange differences. So that will be important if you prepare a statement of profit and loss and other comprehensive income. Once you have the translation of the SOFP done, proceed as normal. Do your normal goodwill calculation, do your normal adjustments in terms of bringing everything in, and only then, once you have all that prepared, you can calculate the third foreign exchange difference, retranslating goodwill at the closing rate. And again, don't worry, we'll come to that as we go through the question. And the final thing then is you prepare the statement as normal, depending on what is required, and there will be some specific IAS 21 issues relating to foreign exchange differences that you need to make sure you've included, either presentational or specific line items, as you go down along. So again, it's only for you there to take note of the type of approach you should have. It may not be exactly step for step, but again, you should have someone that you've tried or tested and you can get out in the relevant time allocated to a consol question. Right, so let's kick straight into the question. You'll note here I have set up the structure of the question, again, for the purposes of the screencast to make it more efficient, but also I tell students that when you are preparing a consol question, the first thing is to always look at the requirements. So if we go to the question 2, we know now there's 2 key requirements. It's prepare the consols blocky, statement of profit and loss, other comprehensive income, and prepare the SOFP. So we don't have any statement of changes in equity. So based on those requirements, I know straight away I only need to have the SPLOCY and a statement of financial position. Now, just for tutorial purposes, I will include a statement of changes in equity, but again, it's not required in the question, but it's useful to know how it would be presented if it was. So that's the first part, just you can set up the structure of the question. Some students like to just set it up straight away, leave a placeholder, leave a few blank lines. It's not required, but some students like to have the structure there to slot in the numbers as they go along. But my advice would be, depending on what's required, in this case you have a SPLOCY and a SOFP, I'd leave 1 blank page at the start for your SPLOCY and maybe 2 blank pages for your SOFP. So you have the pages there in the front and you can fill them in as you go along, or at the finish when you're tidying up the end of the question. The next key thing is to have a brief read down through all the question and try to highlight anything that may seem unusual or that you may have to come back to. So we see here there's 2 companies. There's XONE, which is a euro-based company, and YEND, which is a groupie functional currency. So it's a foreign subsidiary, therefore you know straight away it's going to be an IAS 21 style question. So you're told information here about how much was invested from the parent in YEND, and we're given other information. So nothing really stands out there. Similar, we're given splockies for the year for X1, and again the Y end is in the Gruppy currency, so that will need to be retranslated as per IAS 21. So we're told here X1 acquired 90% of the shares in Y end on the 1st of January 2015. So again, you need to get the discipline here of writing down or noting it's 90%, therefore it's definitely going to be a subsidiary, but you will have an NCI. So there will be a 10% NCI on the 1st of January. So that's very important. That means it was purchased in the current year. So there will be no prior year foreign exchange differences. So that makes a big difference here. It makes the question a lot more straightforward. So you're told what the retained earnings were, the fair value of net assets, and you're also told the fair value of shares not acquired. So that means the NCI is going to be measured at fair value. So there will be some goodwill to the NCI. So it's all these little notes that you need to jot down as you go down through the question. So you're told during 2015 goodwill and the acquisition was impaired and it hasn't been accounted for. You're told trade receivables, there's intergroup balances between trade receivables, and there has been intergroup trading during the year. So again, we're going to have some adjustments there, which is fairly typical in consolidation questions. Finally then, we're told information about all the goods sold to Y end were used in production during the year. So note 3 and note 4 are related. They're all about intergroup trading. And finally then note 5, you're given a number of different exchange rates, and it's up for you based on your knowledge of IAS 21 to figure out what's the relevant exchange rate depending on what calculation you're doing. Alright, but I said that's really the first step, is to understand the requirements and have a quick note down. What's the structure? Well, it's one parent, one sub. There is an NCI, and it was purchased in the current year. So there's no messing with prior year foreign exchange differences. And that's where I then set up my question. I set up my splockie, even if it's just a placeholder for one page. Leave a few lines just in case you need to do anything. And I know my parent is going to be in there in full, so I leave it at that. I'll come back to then the sub and any adjustments. Similarly, statement of financial position. I know there's going to be a number of different lines, so I might put in some of the main subheadings and leave some blank lines that you can fill in as you go along. And of course, I'm going to leave an extra page here just for statement of changes in equity. It's not required in the question, but again, we'll do it now for tutorial purposes at the outset. So I've left 1, 2, 3, 4 blank pages at the start, that they'll be my nice, neatly presented financial statements at the back end, because remember, there are 2 explicit marks going for presentation, so I'd rather get the 2 than leave them behind. My next step is then, I typically, and it's more out of discipline, and now I say a page, but it might only be a couple of lines. What is the group structure? 90% share capital, percentage acquired 90%, and I put the discipline, it's a subsidiary, current year. And that's really just to show the examiner I've spotted it's a 90%, I know it's a subsidiary, there will be a mark going for that, and I know it's the current year, so I don't have to deal with prior year adjustments. So again, very structured. And that's particularly important when you're dealing with JVs and associates as well, so it's good discipline to get into. The next adjustments you're probably going to have to leave a page for is specific to foreign exchange consolidation questions. You're going to have to retranslate the statement of financial position. So we go back to the question. We're given the statement of financial position here, but it's in the Gruppy currency. So that's not really much good to us. We know we need it all in euros because that's what our parent functional currency is. So we have this 28010, and that's the 28010 here. So I've just retranslated, I've just put it in here in the Gruppy, and we need to translate it now into euros. And based on that, we need to use the IAS 21 rules. So you can see here, I've just copied out what the rules are. All assets and liabilities at the year end, all share capital and pre-acquisition reserves using the rate at the date of acquisition, which in this case here will be the 1st of January 2015. Post-acquisition reserves at the rate and the date which they're earned, and all exchange differences recognized in equity. So what we're going to do is, the easiest way, and I always tell students to leave retained earnings as a plug, and we can come back to that then and split out what is actually within retained earnings. So do everything else at the relevant rate and leave your retained earnings as a plug, and we'll come back to show how that actually is made up then and what's within that figure. So we're looking first assets and liabilities at the year-end rate. So the year-end rate, 31st December 2015, is 1.9. So all assets are translated at 1.9. So you're showing the examiner you know what's in, and that's the liabilities. So now we're going to retranslate them. So all you're doing is dividing the groupie amount by the translation rate. So let's do these fairly quickly. Then you can pause this and slow it down if you wish. I just want to show you it's fairly mechanical, but you need to show each of these in the exam as well, because you're going to need to use these to finish off the group financial statements. Because these are the figures now that you're going to pull forward as if it was a normal euro-based subsidiary. The only other two figures we need to translate are the ordinary share capital. Now this should be done at the date of acquisition. So this is the ordinary share capital at the date of acquisition. So in this case we're going to use the date at the 1st of January 2015. Because that's when it was acquired. And that is 1.83. So take the figure here. So 1.83. Just put that out. And finally then you put the plug figure to be for the retained earnings. So they must match. So the sum of these, all your equity and liabilities, needs to match the sum of all your assets. So 14,742. So I'm just going to do this minus 4,315, which is the sum of the rest of them explicitly. So then the plug in retained earnings is 10,427. So we'll come back to what that's in it, what's within that figure again. But the key step initially is we now have all the euro-based amounts for all the other line items that we can take forward and use as a normal subsidiary to consolidate and add with the parent, and of course taking account of any adjustments. But what we want to do now is deal with this 10,427. So if we go back to the steps that we've looked at, we've translated the foreign SOFP and left retained earnings as a plug figure. Now we're going to prepare working to calculate the cumulative FX differences in the plug figure. Because remember, what's within this figure is your pre-acquisition retained earnings, your post-acquisition retained earnings, plus your foreign exchange differences. So we're going to come down and we're going to go do one adjustment to figure out what is within this. Right. So you'll see here I've already the structure used up. I use the T account method. Some students prefer to use columnar. That's entirely personal preference, but it is useful for T account to be able to practice your journal entries as well. All I typically do is open up some of the main, maybe leave 2 or 3 pages, open up some of the main T accounts and slot in the figures that you have so far. So I have some figures so far and I have to slot in the YN figures from the retranslated financial statements up here when I get there. But again, we'll leave them for now, but it's useful to have them set up if you do use that method so you can slot the figures in as you go along. Again, it's entirely okay to use your columnar as well. You're going to come to the exact same answer. But our first step now is to deal with the retained earnings figure. So remember, the retained earnings plug figure is made up of pre-AC retained earnings plus post-AC retained earnings plus the cumulative FX differences. And remember, the cumulative here only means 2015 because you only bought it at the start of January. But based on that then, we're going to have to figure out, well, what are these FX differences that we can strip them out. Because under IAS 21, all exchange differences should be shown separately. So they need to be taken out of this figure and shown separately. So let's go back here and we're going to look at cumulative FX differences, all 2015. So FX difference 1 is net assets. So for the net assets, what you do is you compare what the net assets were at the start of the period and retranslate them then at the end of the period and see what the FX difference was. So the net assets at the start of the period was ordinary share capital. We go and we look at the balance sheet. The ordinary share capital 1 million, there was no share premium, no reval surplus, and retained earnings, this was at the end of the year, so be careful. The opening retained earnings was 14,080 at the date of acquisition. So retained earnings 14,080, and the ordinary share capital would have been 1 million. So add them together, and the opening net assets was 15 million groupies, and we'll translate at the opening rate, which was 1.83, and then you translate at the closing rate, which was 1.90. So that's essentially all the adjustment you do. One of the sources of your foreign exchange difference is the fact that you're translating the net assets at a different rate than was translated at the opening rate. So at the opening rate would have been translated at 1.83. You now need to update that back to 1.9, which is the translation rate that was used in all the assets and liabilities. So at the opening rate, it would have been worth 8,240. At the closing rate, it's only worth 7,937. So it is reduced in value. That is an FX loss to the tune of 304. Right, so I'll just put that in red if it lets me. FX difference 1. And remember, this is all current year because it's all 2015. If this was acquired in the prior year, you'd have to split this between what's for 2015 and what's for the prior year. But this complication didn't arise in this exam question. The FX difference 2 then is to do with the SPLOChy. This is because you translate the income under IAS 21 at the average rate, whereas all the assets and liabilities are done at the closing rate. So there will be a natural FX difference there as well. So the income for 2015, you can get from the question. The profits for 2015 were 5770, and you'll do that at the average rate, and then you'll do at the closing rate. The average rate for 2015 was 1.87, and the closing rate was 1.90. So similar comparison again. Translate this at 1.87 would have got you 3086, whereas if you translate it at the closing rate, the difference would have been 3037. So overall then there's an FX loss again of 49. And again I'll just do the same format here. So what we're saying here now is the total cumulative FX differences, total FX difference 1 and 2 will be 304 plus 349. So the total differences are 352. And the key point being here then is that that 352 loss is embedded in this 10427. So that's part of that plug figure that's taken in. So we need to strip that out because under IAS 21 it needs to be shown separately. So I need to strip out FX loss from retained earnings. So the other key point is you need to credit in retained earnings 352, because remember the loss is in there, so you need to reverse out the loss and show it separately. Now one key point to remember here is for foreign exchange difference 1 and 2, you need to allocate some proportion to the NCI. The NCI does get some of the foreign exchange loss. So you will be debiting NCI some portion, i.e. 10%, and then you will debit a foreign exchange reserve account 90%. That is essentially a separate equity component that's required under IAS 21. So you'll debit NCI 35 and you'll debit the foreign exchange reserve 317. Alright, so that's the key point there. that we looked at that step. I'll show you here. You need to prepare the working calculations and then strip out retained earnings and present it separately, and the NCI should be apportioned their share. So that's always going to be a step when you have a foreign exchange subsidiary. You take out the loss from retained earnings and you debit NCI 10%, you debit the foreign exchange reserve 90%. So that's just the way I do it, I put it in here. So the retained earnings for X is 26,580, which is just taken from the balances in the question. 26,580. And you don't take in the 19,850, you take in the plug figure, which is the updated balance sheet of 10,427. So that's how you open up the T account. Just take the balances you have. Then Journal 1, 352, which is this figure here. And then for the NCI or the reserve, Journal 1, debit 317, and then the NCI as well, you'll do here Journal 1, 35. So again, from your examiner's perspective, it's very easy then to track where all the adjustments are and to follow it through. Okay, so that's essentially the first step, is to strip out any foreign exchange reserves and allocate them accordingly to the reserve account for the parent share and the NCI itself for the NCI's share. The final thing I just want to show you then is how can we prove that that plug figure is correct. So proof of retained earnings plug. Now this is not required, but again it's for you to understand. What did I say the returning earnings plug figure is made up of? It's made up of pre-acquisition reserves at the opening rate, i.e. the rate at the date of transaction. It's post-ac reserves at date earned, so you translate at the date earned, and it's made up of FX differences. That's essentially what that plug figure is made up of. So we can go back and see, can we look at each of these from a G's perspective and from a Euro perspective, just to prove the point that the 10,427 is correct. So again, this is more for tutorial purposes. What are the pre-acquisition reserves? Well, the pre-acquisition reserves at the date of acquisition were 14,080. That was the date of acquisition, 14,080. And those translated at that rate would have been 14,080, as was done up here, at 1.83. The post-acquisition reserves, remember we only owned it for 2015, would have been the 5,770, and they were translated under IAS 21 at the date they were earned, which is 1.87, i.e. the average rate for 2015. And the cumulative FX differences then we've calculated to be minus 352. So hopefully then, I'll just add that up, further, add them up, and that's your 10,427, which proves we're correct. So it's a good sense check that that plug figure is correct, and actually the true retained earnings figure is 7,694 plus 3,086. So it's the 10,780 that's the true retained earnings figure. It was just depressed because it had an additional 352 of foreign exchange losses embedded in that plug figure. That's the most complicated part of the foreign exchange done. You need to calculate the differences and then allocate them accordingly. Alright. The next key point then, as per the steps, is you proceed as normal. So proceed as normal using consolidation approach, using the translated SOFP. So that essentially means this is now the updated subs SOFP. Now we can calculate goodwill as normal. So my ordinary share capital is 2 million for the parent, which is coming from there. Do not put in the 1 million. Remember, that is not a euro currency. You put in the updated balance sheet, which is 546. Alright. The revaluation reserve, you can see here, it doesn't matter because only the parent has reval surplus and only the parent has share premium. So all we're going to be dealing with for the goodwill calculation is going to be ordinary share capital and retained earnings. Now I will do it both ways. I'll do a T account method, and I'll also show you how it shows up as a columnar method as well, just so you're comfortable. So the investment is 8420. Again, you can open up a T account, you don't really need to. That's going to be cleared out to the cost of control. Right, as you see, here's the cost of control. The ordinary share capital, the parent's portion is 90%, goes to the cost of control, and the NCI will get 10%. So you can see how it's very easy to follow what's going on. The cost of control gets 492 ordinary share capital, the NCI gets 55 ordinary share capital. Similar for retained earnings. We know the true retained earnings figure. We've put it in to be 10,779, 10,780, just rounding. But we now need to allocate to cost of control and the NCI. So this is pre-acquisition retained earnings. So do not just do 90 and 10% of this. You need to do 90 and 10% of the 14,080 divided by the relevant exchange rate. So it's this figure, pre-acquisition reserves of the opening rate, that you need to take account of. So it's 90% and then 10%. So you're stripping out the 79694, should I say. You're not stripping out the full amount because some of this is post-acquisition. So it's very similar to what you'd normally do in a question. It's just an added layer of complexity. So bring in here retained earnings to your cost of control, 6925, and retained earnings for the NCI is 769. Okay. So now we just double check if we have any other adjustments that's required for the goodwill calculation. We're told the fair value of net assets is the same as carrying value, so you have no fair value adjustment, but the NCI will be measured at its fair value of 900 grand. So we'll deal with normal goodwill first, according to the parent, then we'll deal with the NCI. So the goodwill here must be the balancing figure of 8420 minus these two, meaning goodwill of about 1,003,000 or 1,004,000. And then what you have to do then is you bring that across and you look at down to goodwill. So cost of control, the opening goodwill is 1,004,000. But we also have to attribute some goodwill to the NCI. So we've currently valued the NCI at its relevant portion, which is 824, but we know it needs to be valued at 9 million. So what we do, or 900,000 should I say. So I typically do is do a separate journal entry 2, NCI fair value top up. And what I essentially do is I debit goodwill, the top up, and I credit NCI. So it needs to be valued at 900. It is currently only valued at its share of assets is 824. So it needs to go up another 76 to get to 900. So if I value that 76, you can see the total value now. We ignore the FX because that is a separate issue. That's an ongoing issue. This is at the date of acquisition. It's now valued at 900, which is its fair value. So journal 2, 76, meaning debit goodwill 76, credit NCI 76. So the total goodwill now is 1,080,000 at the date of acquisition using the historic rate. Now how might that show up if you're doing the columnar? Well, the columnar would be fairly straightforward as well. You'll typically just show the parent, the NCI, and total. I do here cost or fair value. So the cost of the parent was 8420, and the cost of the NCI, so I'll just move these over a bit. NCI is the fair value of 900, giving you a total of 9320. Now we want the net assets at acquisition. And again, it's only represented ordinary share capital and retained earnings. The ordinary share capital would have been 1 million. And the retained earnings at the date of acquisition was 14,080, as we've done in the question before. That means the total net assets at the date of acquisition was 15,080, and that would have been retranslated at the historic rate, which we've already done before, 1.83. So it's 8240, and you give 90% to the parent, and you give 10% to minus as well. I'll just do these normally. And then you do your overall goodwill calc for each of them, which is the cost or the fair value less their share of net assets, which is 1004, 76, and the total 180. So again, it's the exact same approach, you just may do it differently. Each way is entirely okay as long as you'll be able to track the impact on each of the accounts. But the overall result is there's 1,080,000 of goodwill at acquisition. Okay, that's how that's captured, 1080. Now, one of the other things that I've mentioned up here is that specific to consolidated questions, there is a third source of FX differences, and that is that goodwill needs to be, or if you have any fair value adjustment, which we don't in this case, goodwill needs to be retranslated at the closing rate, and that will arise a foreign exchange difference again. So we're going to go to working 3, goodwill retranslation. So the goodwill at historic rate was 1080, as calculated up here. However, we now want to retranslate at closing rate. So if we retranslated the closing rate, we take the 1080, we multiply it by the historic rate to get back to what the figure in groupies was, 1.83. And we then divide it by the closing rate to get what would it be retranslated now at the year end. So it's now only worth 1040, so you now have a foreign exchange loss of 40. Let's do it here. So there's a 40 FX loss, FX difference 3. So one of the key things about this foreign exchange difference 3 is it's only allocated to the NCI if the NCI has some goodwill. In this case, the NCI is measured at fair value, therefore you should attribute some of this difference. So it'll be credit goodwill 40 because you're reducing it, and you're going to debit NCI 10%. So you never show the NCI FX difference separately, it goes all into the NCI, and debit FX reserve 90%. So the key point here is that if NCI was not measured at fair value, all this goodwill FX difference would go to the foreign exchange reserve, none to the NCI. But because it's measured at fair value, you do put a portion. So journal 3 then, you reduce it by the 40. The foreign exchange reserve gets another one, so that's 1 and 2. This is journal 3, gets an additional 36, and the NCI themselves get out journal 3 as well, an additional 4 of a debit. So again, they are the only adjustments specific to the IAS21, the goodwill retranslation, and you give a portion to the NCI only if the NCI is measured at the fair value. And the other thing to remember is both of these FX differences, the full 40 and the full 352, these are current year foreign exchange differences and they will go into the OCI. So remember to label it. I typically, when I'm labeling for a splochy, I will label it with 3 stars and I'll show you that it goes into the OCI, and the full amount will also go into the OCI here. Now, some students may think, why are you putting the full amount in? Well, you put the full amount in the OCI, and when you come to the very end of the splochy, then you can attribute 10% of that to the NCI. So, while you're putting the full amount in, you will be splitting it between the 10 and 90 in the splochy statement or the statement of profit and loss under comprehensive income at the very end. That split will show up. Alright, so now we've dealt with the goodwill retranslation, so let's look at the next note to the question. There's a goodwill impairment. So goodwill is impaired during the year, so it's going to be impacting this blocky, and no adjustment is made. Impaired at 125,000. So we'll go Journal 4, Goodwill Impairment, and it will be simply credit goodwill 125. Now remember here, because the NCI is measured at its fair value, they're going to get some portion of the impairment as well. So they're going to get 10% of it, and debit retained earnings the 90%. So that's only because the NCI is measured at its fair value. And remember, this is a blocky element. It goes into the P&L, not the OCI, because it is a current year. And again, we put in the full amount, because when we get to the very end then, it will be split 10/90 when we do that attributable to parent and attributable to the NCI. So now we just slot in that credit goodwill 125, Journal 4, NCI, Journal 4 gets 13, and retained earnings, Journal 4 gets 113. So you can see it is very neat, and it's very easy to follow for the examiner. If you take this structured approach, they can see where your journal entries are coming from, and they can map that back to where actually you're putting it on the T account. Okay, so that's another adjustment done. Now we're on to the intergroup trading, which we know is Note 3 and Note 4 together. So trade receivables of X1 include 240,000 receivable from Y-end in respect of sales made during the year. Total sales made to Y-end during the year end were 500, or year end 31st December 2015, were 530,000. And your total Note 4, all goods were used in production. So there's no goods on hand at year end. So anytime you have an intergroup trading, there's three main elements you have to watch for. One is remove the sales and cost of sales, i.e. intergroup top line items. Second thing is look for intergroup balances between trade receivables, trade payables. And third thing is unrealized profit. So in this case, there's no unrealized profit because all the goods are sold on, are used. Secondly, there is intergroup sales and cost of sales of 530. So let's put down that intergroup trading, Note 5. Debit revenue 530, credit cost of sales. And both of these go to this blocky. So these labels are going to be very beneficial and very efficient when you start finishing off your statements, that all you have to look for is your relevant labels and slot them in. So it is a good way of getting marks very quickly and ensuring you don't forget them or have to dig back into the workings to figure out what adjustments are required. The other element we're told here then is trade receivables of X1 include 240 receivables from Y-end. Therefore there's an intergroup receivable again. So what you simply do is you'll debit trade payables and credit trade receivables. So these are relatively straightforward adjustments this year in terms of the intergroup trading, and there was no unrealized profit. So these do not need to go into the T accounts because they have a net and nil impact, but these items do. So you can be smart with your T accounts. I don't even have them open up here. You don't really need to open up a T account for trade receivables and trade payables because all there is one small adjustment. So you might make a note to remember to make those adjustments at the end, because opening up T accounts for everything really is not efficient and there's no need. That's why a lot of students are put off T accounts. They think they're very slow and cumbersome, but you don't need to open up T accounts for every single item. So the final thing we need to do after we've all the adjustments done, and it's one thing the students do forget a lot to do, is, so let's bring it down here, is to actually allocate post-acquisition earnings to the NCI. So currently we've now given no post-acquisition earnings to the NCI. So if we go up and I look at our T account, all we've done for the NCI currently is valued them initially at 900 and made some adjustments for goodwill impairment and foreign exchange reserves. But there has been profits in 2015 which are post-acquisition. So post-ac profits, i.e. 2015, have been 5770 in groupies, and they would have been earned at 1.87. So that's what the average rate would have been in the question. So you need to translate that back And we've done this already in the question. So 3086 is the profit that they would have earned during the year. So we need to give them a share of that profit. The NCI share is 10%. So 10% is about 309. So all you simply do is debit retained earnings, credit NCI. They get their share of the profit, 309, and I'll bring this over, 309. So that's one step the students always seem to forget, is to allocate the post-acquisition profits to the NCI. So all that's Journal 6, 309, and then Journal 6 here, 309. So now we have all the adjustments done. We've given the profit to the NCI. We now simply tot up all the relevant accounts and slot them in. So for example, retained earnings will be the sum of the credit side, which in this case is 37,359, minus any debit entries, gives me the balancing amount to be 29,244. So that is the figure that you can put in for retained earnings in your finalized SOFP. Right, so we'll just take that up, because I've prepared earlier and we can slot it in. That is 29,244. Alright. Same we can do with goodwill. So you can see once you have the workings done, you have a lot of the calculations done as well when you have the T accounts done. So SOFP will be a balancing figure on the credit side, which is obviously brought down to the debit of 1080 minus 125 minus 40. So goodwill will be 915. That's 915. Any other account that we can finish off, so cost of control is gone because that feeds into goodwill. Revaluation reserve, well, that stays at 600 because it's just the parent and there's nothing from Y end in it. So reval reserve stays at 600. FX reserve is FX1 and 2 plus FX difference 3 is 353. And note, this is a debit balance, so don't get caught out here. This will be a negative figure in the equity section. So minus 353 because it's a debit balance. So remember, these FX losses. So you can see it's fairly quick once you get all the accounts done. Share premium remains at 300 because you don't have anything from the subsidiary. Ordinary share capital should remain at, take off these two, 2 million, which again makes sense because you should never have any share capital of the parent left. So you can add them up. Let's keep working down. So we have the NCI as well. The NCI will be the sum of the credit side minus the balancing debit entries, meaning we have 1157 to be brought down on the credit side. So that gives me my NCI. And they are all the T accounts that I've done. So everything else then should be fairly straightforward, barring the trade receivables and trade payables. I know I have one small adjustment. But because the examiner knows where these figures are coming from, because I have my T accounts done. For everything else, you don't need a T account. It would be very inefficient to do a T account for everything. You just add the parent, which in this case for PPE would be, the parent would be 14220. Now do not add in, some students make the habit of adding in 16120. That isn't the wrong currency. You need to use your retranslated balance sheet 8484. So translated using IAS 21 rules. Okay. Similarly for inventory, it's the same approach. You take the parent from the question, which here is 6550, plus the retranslated balance sheet 2400. Now, I've put a note here to the examiner, include intergroup adjustment, so they know that I haven't just forgotten it, and I might reference here Journal 6. So there's no point in doing a big T account out. It's only one adjustment. You'd be a lot quicker to do it here. So it's the parent. Sorry, this one. Parent is 7850 plus the subsidiary translated 3342 minus 240 for journal 6. And the cash is the same again, so this is fairly the same, 3660 plus the translated amount 516. And you do the same then, we have the NCI, long-term borrowings is the same, so we won't spend too much on this. 3 million for the parent plus the translated subsidiary is 1063. Trade payables, and I'll say including adjustment journal 6, because remember there is intergroup balances, so that will be the parent, which is 7230 plus the sub, which is 2226 minus 240 as per journal 6. And again, we'll just wrap up these two. Current long-term borrowings is 320 plus 116, and tax is 670, correct? 670 plus 363. Alright, so what we need to do then is we need to add these figures. So the equity and liabilities will be your current liabilities plus your non-current plus NCI plus equity, and 47,697, and that matches exactly the 47,697 above. So again, there is a small bit of work, but I would just be to the examiner then, anything that I haven't a T account, I just put in SOFP balances, just to show the examiner that's where all the figures are coming from, and there's no confusion as to where they come from. And I've told about the journal 6 for trade receivables and trade payables. So this wasn't the worst of questions, but there was a bit of detail involved in terms of figuring out what adjustments need to be made to foreign exchange differences, and then when you are preparing the final group statement of financial position, to make sure you pull the right figures in and you do not just simplistically add 14, for example, property, plant, equipment, and 16. These are two different currencies. You need to use the updated statement of financial position from your initial translation. So once you have the statement of financial position complete, you then move on to your statement of profit and loss or other comprehensive income, or your SPLOCI. Now, as I said before, you will have a number of columns. You have one subsidiary, therefore you have the parent. Parent's results always go in full. You'll notice the way I have structured the subsidiary. Now, some people like to put in two columns, one for the foreign exchange figures and one then for the euro figures. I also put a yellow box up here. This is just to get good discipline that if there is a mid-year acquisition, you're reminded to think how many months of the results should go in. Because this is a full year acquisition at the start of the year, you will put in the full year results. Now what I'm going to put in here is the translated SPLOCI. So remember the rules of IAS 21, income and expenses are at the average rate. So you're going to translate the SPLOCI given in the question, for example here, into the average rate using 1.87, the average rate for 2015. So that will give you 50220 divided by 1.87 minus 35640 divided by 1.87. Other income is nothing. Minus 3450 divided by 1.87. So you can see it's fairly mechanical. 4420 divided by 1.87. 720 divided by. So again, all I'm doing here is updating and using the correct euro-based amounts based on the IAS 21 rules. And you'll notice that the profit figure I got here, 3086, is the one that I've been working with below already. So the 3086 at the average rate, and when I came down here, the 3086. So I know I'm correct. The results have come down correctly. So the other thing that you need to do now is you need to bring in any relevant adjustments from your workings in terms of the SPLOCI. And this is where the labeling system that I use really comes into its own. I don't have to dig into each of the workings again now. All I have to look for is my labeling system, where you have a 3 stars, it'll tell you that goes to this blocky, and you just pick that out and put it into the relevant column. So it does save you a lot of time preparing this blocky. So using these labels then, we can then slot them into the relevant sections of the blocky. So for example, the 352, we can put in exchange differences. We know one of the adjustments will be minus 352 to be one of the last. Now I won't sub them up a second. That's one of them. So we just go down again. We're not looking at the detail. We're just looking for the different labels. We know the minus 40 will also be a current year foreign exchange difference. Remember, IS21 says all of these go through the OCI. So they're not shown as core P&L. They're shown in this other comprehensive income section. And we have 125, which again is not shown in the OCI. It's shown in the P&L itself. So that's a goodwill impairment, minus 125. And we have the 530 adjustment as well for cost of sales and revenue. So you have minus 530, reducing revenue, and plus 530, reducing cost of sales. And we'll put admin expenses for the goodwill impairment. So the core main adjustments. So preparing this blocky is very straightforward once you have a good labeling system in place. You add across the parent, the sub, and the adjustments right the way across. And you should get to your 7731 to be the profit after tax. And again, we then add in the two exchange differences to get other comprehensive income to be a negative 392. So that negative 392 is the total of the three foreign exchange differences, right? Both the NCI's portion and the parent's portion. So typically down to here, a lot of students should be okay. But remember, one of the key points are that a lot of students do forget is you need to give these two boxes as well for preparing a consolidated blocky. So you need to attribute both the profit figure, i.e. the 7731, but also the OCI figure, the total comprehensive income, 7339. So typically what I get students to do is when you are trying to figure, well, how much of that profit now is attributable to the NCI? Well, the subs profits for the year was 3 million, and is there any relevant adjustment that is associated with the subs profits? And this 125 is. So typically, and again, I forgot to do it in this instance, but when you're down here, I typically, if there's any subs profits, I put a capital S. So the capital S signifies that that will impact the calculation of the subs, or the NCI's portion of the subs profits. So when we're calculating the NCI's share, it will be 3086 plus negative 125 times 10%. And that's how you get to it. That comes to, all right, put a bracket there, 296. So 296 is the NCI's share, therefore the difference will obviously be the parent's share. So that's how you do the NCI for the profit is, you look at the profit for the sub for the year, and you take off any relevant adjustment that will impact the sub's profits. In this case, the 125 goodwill impairment, 10% of that is as a portion to the NCI as well. So that's where your 296 is coming from. 10% of this minus 10% of this. Now when you come to total comprehensive income, you start off with the 296 as the base for the NCI, and you have to decide how much of the other comprehensive income, i.e. the foreign exchange losses, go towards the NCI. And in this case, they all go towards the NCI. So it's 392 plus 392 times 10%. And just be careful there, because sometimes if you have a goodwill apportionment, you may not attribute to the NCI if the NCI is not measured at fair value. But because all FX differences are attributable to the NCI, in this case, you attribute the 392, 10% of that loss goes to the NCI here. And of course the difference then, 7339 minus what goes to the NCI, well, is what the figure is for the parent, 7082. So that is the one thing that catches out students. To calculate the NCI's profit share, you take the profit for the sub and make any relevant subsidiary adjustments. For the total comprehensive income share, you start with the profit share and you give them the relevant share of any other comprehensive income, typically revaluation reserve movements or in this case here, it's exchange differences. So that is how you prepare your SPLOCky. A lot of it will come from labeling system from your prior adjustments, and then you will allocate at the end your profit and total comprehensive income. So that's what the requirements were for this question. You were asked for the consolidated statement of profit and loss to other comprehensive income for 9 marks, and the consolidated statement of financial position for 14 marks, with 2 for presentation. So just to round things out for tutorial purposes, I have also included a consolidated statement of changes in equity. So remember, this is doesn't appear as frequently on the CAP2 exam, but it is important and it is a core part of the IAS 1 financial statements. Your starting point is the number of columns in the statement of changes in equity will match the number of line items in the equity section of the SOFP. So in this case, there's 1, 2, 3, 4, 5, and including NCI is 6 core columns, and then a totals column. The closing balances is where you start, because you'll work back towards the opening balance. They will be the balances as per the SOFP. So you can see the 2 million, 300, 600, 29.2, minus 353, and 1157. And then it's up to you then to slot in, well, what movements occurred during the year that will help explain the movements here. Well, one is profits. So the profit that goes in the retained earnings figure is the profit for the parent, 743. So we do not take the total comprehensive income. This OCI goes to its own line. So 7435 goes there. The FX reserve movement, that is the FX reserve that went to the parent only. So the portion that goes to the NCI is subsumed within the NCI. So the difference here between this and this, which is 353. So of the 392 full adjustment, 10% or 39 would have went to the NCI. Hence that's the difference between 257 and 296, 39. And the difference between the 7082 and the 743 is the 353. So that is the balance that we're looking for that goes to the FX reserve, the 90% of it. And the NCI's profits or total comprehensive income for the year, it's this figure that's taken. So that can be slightly confusing. The NCI, you take the total comprehensive income because it subsumes any exchange differences into its overall figure of 257. So that's the first one. That explains some of the movement. And remember, you do have an acquisition of the NCI during the year, and that sum total was 900. Alright. So overall, the opening NCI should be nil. So for rounding errors, it's nil. We get to 1157. The opening in the FX reserve should also be nil, so you can sense check that. That makes sense. So opening plus the movements get me to the closing. And the opening balance in retained earnings, it won't be nil. It says here it's 21,809. So can we prove the opening balance? So the parent, which is this case, it's X1. So what was the X1's opening retained earnings? And if we go back to the question, the opening retained earnings for X1 would have been 26,580 minus the profit for the year of 4,770. So plus 26,580 minus 4,770. So 2810. So a small bit of rounding, but we've proved that we're correct. Now you don't need to prove that, but it's a good sense check that unless you're getting back here, and remember for Y end, there will be nil because it was acquired during the year. Alright, so in total then, you can see that the opening retained earnings for the group is 21,810, and that's what we've backed into using our consolidated statement of changes in equity. So you don't have to prove that, but it's a good sense check when you're going through questions that even if it's not required, it's a good practice of your statement of changes in equity, which is typically or traditionally one of the statements that students do struggle on. Right? So this screencast looked at Summer 16 question 2, focusing on foreign subsidiary under IAS 21.